Hey, good afternoon. I'm Simone Del Rosario, the business correspondent at Straight Arrow News, joining you from a slow news week, right? Just kidding. It's been a couple of days since the presidential election, and Donald Trump has been declared victorious by the voters of the United States of America. So as we look to having a new president take over in January, just 2 days later, the Federal Reserve is coming out with its rate cut decision. In its first post-election rate cut decision, the Federal Reserve has determined that they are going to be cutting their interest rate by 25 basis points. This was an unexpected move. The markets expected a 25 basis point cut to happen this week, just 2 days following the election. And to get into what's going to be happening in the future, I want to bring in the Fed guy himself. Joseph Wang is the CIO of Monetary Macro. Joseph, this was an expected move for 25 basis points. And I'll add that in 20 minutes, we're going to be hearing from Fed Chair Jerome Powell himself. And I imagine that today, given we had such an expected move, we're really a lot more interested to hear what Powell has to say as he indicates what's going to be happening moving forward. First of all, how are you and what are you thinking of today's decision?
Oh, thank you, Simone. I'm doing well. Thanks for inviting me. And like you mentioned, this was well anticipated by the market, so there was no surprise here. Now, the way the Fed works is that they're very conservative and very slow moving. So they don't want to surprise the markets. So they've been very candid that, this is going to be a rate cut now and most likely a rate cut in December as well. But because we did have some, a bit of a change in the world this past week, I think it's going to be much cloudy heading forward because there could be some big changes in economic policy next year, and the Fed is going to be thinking about what that might mean for growth and inflation. So there's a lot of anticipation here for the upcoming press conference to know what the Fed is thinking. And of course, in the past, President Trump has made commentary on the independence of the Fed, and maybe that could change as well. So there's a lot of things happening in the world that could impact monetary policy. But for today, though, this is not going to be super eventful.
Okay, so you touched on a lot of things, and luckily we've got 18 minutes to talk before we hear from Fed Chair Jerome Powell. So we do have a lot of room to talk about what's going on here. Let's first dig into those policies. What sort of policies are you expecting might change the Federal Reserve's path? As consumers know, the rates have been high for a very long time as the Fed has been trying to bring down inflation. We've finally kicked off this rate cutting cycle as inflation has come much closer to the Fed's 2% target. So how might some policies change things from the baseline expectations?
So President Trump so I think, first of all, we have to realize that what people say on the campaign trail is often different from what they actually do in office. So it's really hard to make a judgment at the moment. But there's been some analysis by nonpartisan organizations that suggest a Trump presidency could entail a lot more spending. And when you have a lot more fiscal spending, that usually puts upward pressure on growth and inflation. Now, in addition to that, President Trump is well known for his stance on immigration. He would like to have a more secure border and more legal immigration. Now, over the past few years, we've had tremendous amounts of illegal immigration to the tune of millions and millions. Now, that has, I think, put downward pressure on labor. So maybe if we have fewer people entering the country, we might have higher wages. Now, I think that would be a great thing for the American worker, but it could also change the Fed's calculations when it comes to inflation, since one of the big inputs to inflation is services, and services is highly driven by labor. And of course, we also have Trump's views on trade policy. If we have more tariffs, now I don't know if this will actually happen. It could just be a negotiating tool. It could increase import costs. Again, these are all things that are up in the air. We don't know what will actually happen. We don't even know what the Trump's cabinet will look like next year. But these are all potential things that could impact growth and inflation and will have to be on the Fed's mind. And of course, ultimately, Fed independence matters as well. And we won't know much about that until next year as well.
It is interesting because inflation was such a big conversation this election cycle. But to your point, the independent analyses believe that Trump's campaign promises, again, we'll see what happens in January, but like you said, a lot of these things add inflationary pressures. So How much of his policies do you think would be implemented? And more importantly, what are businesses doing today to prepare for the Trump presidency? Is there a concern that in anticipation of tariffs, in anticipation of higher cost of goods being imported, businesses might already raise the price on consumers?
So that is possible. So I hear a couple of ways that businesses are getting ahead of a potential change in policy. So one way, of course, is to stockpile goods. So if you do that, again, maybe you get to buy before the tariffs come online, and that sudden surge in demand could increase prices a bit. Another way businesses are trying to get ahead of this, especially foreign businesses, is actually just building factories in America so that in the future, let's say that we do have less international trade between, say, the US and China. Well, you could build factories in America or in Mexico or in other countries that would help them get around that. And that's been something that's been happening since the first Trump administration. So maybe it's getting some new urgency right now. But a broader point that I'll note, though, is that heading into this election, a lot of businesses, according to surveys that I read, have been slowing down hiring and slowing down their investment. Vice President Harris and President Trump had very different visions of the world. So if you're a business, obviously you have to be a bit more prudent and try to plan ahead of that. Well, you can't plan ahead of what you don't know, so you got to wait. And then when you get clarity, you can do something. So I think that even though we had a slow patch in the economic data the past few months, this clarity we got in November is going to help businesses plan better, and it should be positive for the economy, at least for the next few months, especially since President Trump is perceived to be, by the business community, to be more business friendly.
We've seen it in equities just since Trump won the election. Businesses seem to be, and investors seem to be very happy with the result right now and are really taking off. And there hasn't been a ton of correction today from the records being hit yesterday. In fact, the stock market's up even more. Do you anticipate that movement to continue as the way you see it? Businesses are feeling like the environment might be loosened up and growth might be loosened up to be able to explode even further.
That's certainly the market's verdict. Now, when I look at the markets, you have to look at various asset markets beyond equities. Equities up, yes. Also, interest rates up, but also the US dollar is up. Now, when you take these things together, it's very clear the markets perceive a positive growth shock with a Trump presidency. And I think that's reasonable. If we think back to the first Trump term, there was a lot of deregulation, there was a lot of fiscal spending, and it was a time when there was strong growth and low inflation. And so maybe a lot of the investors remember that. So far, it's been looking like the market is anticipating better growth going forward.
And you mentioned those higher interest rates expectation. So that would, I guess, would that change the direction that the Fed is going or the slope of the Fed's direction?
Yeah, so over the past few months, the market has been pricing in a lot of Fed cuts. Now, the reason for that is because the market has been anticipating a recession. Now, we've seen the job numbers every month. They're growing, but they're growing at a decelerating rate. So right now, the market is seeing that, going forward, we have a new change in policy. Maybe we get a lot more spending. Maybe this growth thing is going to turn upwards. And so it's beginning to see that, maybe we're not going to go into recession. And if we're not going to go into recession, that also means that the Fed does not have to cut rates as much. And so even though the market is pricing in one more cut this year in December, it's pricing in a lot fewer cuts next year, and that's pushing interest rates upwards. So the positive interest rates is consistent with the perception that we're going to have a better economy, more growth going forward.
We had such a weird jobs report that just came out, especially in contrast to the month before. The month before was well above expectations and above the 12-month moving average, more than 220,000 jobs added upon revision. This last jobs report showed 12,000 jobs added. We had strikes going on. At the same time, we had 2 hurricanes and the effects of that. Do you think the Fed is ignoring that black mark of a jobs report given everything that's going on?
I hope so. I mean, like you mentioned, Simone, you had a lot of crazy things happening that month. You had the strike with Boeing, you had the disasters we have in North Carolina, you had the hurricanes and so forth. So that job report, I would just throw it in the garbage can. It's not going to be very helpful. There's just too many confounding factors. But the trend, though, is very clear that the labor market is softening, and that is a reason why the Fed is cutting rates today and is likely going to cut rates in December as well. Now, going forward, though, like I suggested earlier, businesses seem to have slowed down their hiring in part due to election uncertainty. So going forward, maybe the job growth will pick up again, and that could lead to fewer rate cuts next year, as the market is currently expecting.
Let's talk about what Fed Chair Jerome Powell is going to say. Again, he's going to be coming on this live stream and speaking in 9 minutes. You'll be able to hear from him. You know, he likes to keep things pretty close to the vest as far as not looking too far into the future, trying to be very clear with what he is saying. What do you expect him to say today? Do you expect him to make comments about the results of the election and how that might impact their policy plans moving forward?
I expect him to be asked about that in 10 different ways by every single person there. And I expect him to say nothing about it. Chair Powell throughout his tenure has been very politically astute about this. Very clear to say that he stays in his lane, running monetary policy, will not comment on other parts of the government. But unfortunately for him, other parts of the government have been commenting a lot about the Fed and him particularly. Now, when we think back to the first Trump administration, President Trump has been very vocal in his displeasure on the performance of Chair Powell. Now, I think what will be asked of Chair Powell as well is on the Fed independence. So in addition to potential changes in economic policy, is he worried about changes to Fed independence? Now, Chair Powell is probably going to say that he will do his job as it was given to him by Congress. But note now that President Trump won the election with a commanding lead, with a popular vote, and looks like he's going to sweep Congress as well. And so that tells the world that President Trump has popular support and mandate to maybe also influence monetary policy as well. And so going forward, I think that's something that we need to bear in mind of whether or not we will have maybe a less independent Fed. And that's not necessarily a bad thing, but it will be different.
Okay, so let's just cover a little bit of the history here. Fed Chair Jerome Powell is a Republican. He was first appointed to the Fed Chair position by former President Trump during his first term. He was reappointed to that position by President Joe Biden. But in Trump's first term, they had very public feuds about interest rates. Trump wanted him to lower interest rates, was, strong-arming him while the Fed maintains its independence, stays as an apolitical body, and makes monetary decisions based off of what's best for the economy in their minds at that moment and not who's in the White House. Since that time, as President Trump has been running for this re-election campaign, he's been there's been a lot of whispers, to your point, of people who are expected to be working in his new administration, people who are his aides, saying that they want Fed Chair Jerome Powell out of there, despite the fact that his term goes up until 2026. That all laid aside, I know obviously that you know that. I just wanted to kind of go over what's going on right now as we get into what is a consequential election for Fed Chair Jerome Powell, as he's about to be working with a president who very publicly disliked him, even though he was the first to appoint him. Let's talk about what those options are. There were whispers about a President Trump appointing a shadow chair, which would, kind of cut off Fed Chair Jerome Powell's power. What do you make of those types of things and possible actions that will be taken once Trump is back in the White House?
Yeah, that's a very good summary of the recent history there. Now, when you have control of Congress, basically you have a whole bunch of tools that you could do to influence the Fed. Like you noted, one of the potential Trump Treasury secretaries has floated an idea where maybe Trump could just nominate and confirm the next Fed chair after Jay Powell and just have this Fed chair go around and give all sorts of speeches and influence the markets in that way. That's very creative. I don't know if that will happen. Or you could just, pass new laws, nominate new governors, pack the Fed, or you could have legislation that maybe defines the Fed's mandates in ways that are pleasing to the executive. Or if you look back to history, in the beginning, when the Fed first started in the early 20th century, the Treasury Secretary actually sat on the FOMC. They're participating in the discussions. So there's a whole bunch of ways this can go, simply because Trump has control of, the Republican Party has control of Congress, and also it's seemingly a popular mandate. So if President Trump would like to exert more influence on the Fed, he can absolutely do it this time around, simply because the political landscape has changed. Now, I suspect that, the Fed is going to be aware of this. At the end of the day, the Fed is a group of unelected people who serve the public. And so they are, they have to bend to the popular will. And we've seen that happen in the past as well. Let's say in the 1970s, Chair Burns at the time, he was living in a time that was very populist. And in his speech, The Anguish of Central Banking, which he gave after he left the Fed, he noted that a lot of changes in the politics and the culture at the time made it very difficult for him to be tough on inflation, and made it so that he had to keep rates a little looser, simply because that was the spirit of the era. And maybe we are in another such era as well. That's certainly what the election suggests to me.
Knowing how Fed Chair Jerome Powell moves, do you anticipate that regardless of any friction, he's going to remain in the chair until the end of his term?
Yes, I have confidence that will happen. President Trump, as I recall, and again, political figures say many things. Sometimes they change their mind. President Trump has suggested that he would let Powell serve out his term, just also noting that he thinks he's an experienced businessman, and maybe, he could have some suggestions as well, but would never order the Fed chair to do anything.
Let's talk a little bit about that, because I've thought about this a lot. This idea, Trump is very involved in the business world and has been his entire life, something that is different from other presidents. So when we talk about whether or not the Fed should be independent of who's in the White House, just because President Trump wants a say in what's going on economically, does that mean that is what is best for every administration in the future?
No, you're exactly right. Now, the reason that we have an independent central bank is because the political branches often have a temptation to do things that are good for them today, for their current election cycle, that have bad consequences later on. And you see this in Latin America all the time. Government comes to power, spends a whole bunch of money to get elected, and then the inflationary problems, someone else's problem. So we don't want that to happen here. Now, that being said, like you mentioned before, sometimes the person in the White House does have good expertise on the economy, and sometimes what you learn in textbooks is not super helpful. Now, when you think back to 2018, for example, when there was that very public feud between President Trump and Chair Powell, Trump wanted to lower rates. The Fed was saying that they would hike rates and continue to hike rates in 2019. The end result of that was the equity market collapsing, and in January of 2019, the Fed making a tremendous U-turn, basically admitting that, yes, they should have cut rates and rates were too high. So I think having input from a wide range of stakeholders is a good thing to have. Definitely, we want to have independent monetary policy. We don't want the president ordering the Fed to do anything. But I think having the elected government participating in discussions is not a bad idea.
So we're about a minute away, and we know that Powell is very timely. I'll ask if we can get his podium shot up as we continue to talk here with just a minute left before we're going to hear him speak for the first time since the election. So it'll be very interesting to hear what he has to say. Before he does begin to speak, I just want to ask you to clarify this. Can Trump demote him to commissioner and take him out of the chair, and he just serves out the rest of his term as commissioner?
So I don't believe he can do that, but unless he has unless Congress is also there with him as well. So I think if he could have done that, he would have done that his first term.
You think?
Yes. Trump has already commented that he's going to let Powell serve out his term. I expect that to actually what actually happens.
Yeah, and we talk about it. I think not to say that what the Federal Reserve wants is what's best for the markets, but both of them have an interest in stability and things going as expected, which is something that the Federal Reserve really leans on, is making sure that the markets are not surprised by what's happening, and perhaps trying to have a further public feud with Fed Chair Powell would do nothing but continue to surprise markets and make them a little bit more unstable. Here he is. We're going to listen in now. Thank you so much.
Thank you, Simone.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long bond rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You know, you get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. You know, let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and you know, by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and you know, we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
You know, we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September. And in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. You know, we're just going to have to see where the data lead us. We have, you know, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but you know, I would say, you know, I would say that. You know, again, we didn't update the SEP, so I'm not going to characterize, you know, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, we have a very large economy. Many things are affecting it at any given time, and a law change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time, and of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restrictions to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, 3 weeks later, the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now, it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. With the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So yes, we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing. We're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be one or two really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. Two questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place, and our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market, while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation, given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria.
Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
Andrew.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is, to follow up on Victoria's question, do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail, tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk. And to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage, and so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to maintain, support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing where we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important, the precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of neutral, a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is, and we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen, up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022, was to avoid that.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is, it takes some years of real wage gains for people to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down, the economy is still strong here, wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened, but it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true, they're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
Well, so that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.